There are, of course, plenty of stocks out there, but that doesn't necessarily mean that most of them are good options to buy. Today, we're going to be looking at 3 stocks specifically that are growth oriented, and the first one is Oracle. Oracle is up over the last 5 years 184%. That is a good performance. The S&P 500 is up about 90% over the last 5 years. Of course, you can find better performances, but this is still a company that's done very well. Since early 2015, about a decade ago, we're up from the low 40s, maybe 45 at a peak. This is a company that has done well over a long time frame as well. But it's not just the stock performance, it's what they do as a company. They do a lot of different software, things like that, but specifically what I'm interested in, and I think there's going to be a lot of growth in, they do a lot of software relating to data centers and that sort of area, not just data centers, but that sort of thing. You got AI data centers and you have cloud stuff. So there's a lot of stuff there, and Oracle is right in it. And I think it's pretty clear and obvious that there's tons of investment into that specifically, but I think that's only going to ramp up later into this decade, and I like Oracle being positioned well for that. And not only that, but you also look at the PE, it's at about 40 right now, the S&P 500's at 30, you say, okay, that's about what I would expect, and that's okay. But if you look at that forward PE, 26.5 compared to the S&P 500, which is at about 23. So this is a company that, if you go off forward PE, assume everyone hits their marks, which of course there's no guarantee. This is a company that's really not much more expensive than the S&P 500 in a year, and you're at a company that is growing well in a very good industry in tech. Software companies have higher margins as well, and you're not buying on exactly all-time highs, which isn't always matter, but for here, you're buying not at crazy highs. You're at about 154 right now. So for many reasons, I like Oracle, and I've stated quite a few of them. So we're going to move on to the next one. That is MasterCard. MasterCard's only up 63% over the last 5 years. But they're kind of in a unique spot because early 2015, which was about a decade ago, they were at 90. And then over the next 5 years, they ran up all the way to 315. And then now today we're sitting at 504. So this is a company that's been over the last decade. If you bought 10 years ago and you just showed you a snapshot into the future and you're like at 500, you're thinking that's fantastic. So over the long term, this company's done very, very, very well. And we see a lot of that is probably due to the PE ratio on top of growth. So credit card companies, if you look at them, they are so consistent in year after year after year, providing more revenue, providing more earnings per share, more, I said my brain was saying EPS, but that's the same thing as earnings per share. So MasterCard has done very well. And if you're looking for stocks to consistently perform probably better than the market, maybe not by a bunch, right? You're not going to have an NVIDIA where you're up 3,000% over 5 years. It's not possible with a credit card company. However, I think over the long term, these companies will continue to dominate because there's only so many, so there's not a whole lot of competition. You aren't desperately clawing your way to get some, little margin out of it or every single customer. So there's a pretty large moat there. There's not a lot of competition. Most people already use some of it. You're already in all the stores. Everyone takes it. You're in more and more countries. And there's people that try to start like new payment stuff, and it's just almost impossible to make a breakthrough because you can only get in some stores. So the moat that these companies have, along with being able to just generate these revenue year after year, just growing revenue year after year, that's why I like these companies a lot. And I would put it in that growth category because of the PE ratios, right? You're at 38. That is pretty high. If we go to forward PE, it looks a little bit better. You're at 30, 31. Actually, MasterCard is one of the more expensive. If you're looking for more value from this, you could probably look to something like American Express, which is inverse. They haven't done as well over the last decade, but over the last 5 years, they've done better than MasterCard and Visa, which are the two that are larger generally, but also have larger PEs at this moment. So I like all three as long-term holds. If you're looking for more value, American Express. If you're looking for more growth, MasterCard and Visa, although I would not be too surprised if MasterCard and Visa underperformed American Express. But there's still all three good companies, crazy growth. Next one we're looking at, and the last one, is Apple. Nothing too crazy here. However, let's look at this one. I'm sure most of you know about Apple. 5 years, 205%. They've went on a bit of a run since earlier this year. They're kind of unique in this. You see a lot of, with tech companies, Oracle, you see semis were kind of hitting highs in, June, July-ish. Oracle was hitting it a couple months ago. And now Apple is hitting all-time highs basically right now, 236. It's done well. Apple's Apple. The people are starting to get hyped about their AI. If they can implement it into their services, which there's no indication that they wouldn't be able to, right? They can get more revenue from that. The services is one of their key industries they're trying to grow in. A lot of people already use smartphones, already in the Apple sphere, right? And then you can get more money from them by making them pay for Apple Music or just things like that. So if they can implement AI into that, you're going to see a lot of growth, and there's some hype and some people buying into that. And Apple is one of the most consistent companies in terms of, just look at this chart. Just crazy. Going back to even just 2015, 30. You're at 236 now. And it's almost none of that's, some of that's from P. It just looks crazy. Now, are you going to be able to do multiples like that? Who knows? Over the long term, you might be able to, but I don't know. But anyways, I'm a little bit doubtful on that. But anyways, forward PE, 32 forward PE. It is a bit high. But this is one of those companies where if you bet against them growing, you bet against them growing fast, you've always lost, basically always lost since what? The 90s, 2000? Apple has just done well consistently, and I don't want to doubt their leadership too much. Now, would I have a bunch of my money in this? Like crazy amount of my portfolio? Probably not. Am I saying, oh, this is screaming buy right now, like, oh, it's so cheap? No, I'm not saying that. However, I want Apple. I want Apple in my portfolio over the long term because they have proven to me that they are a company that can consistently win and consistently provide excellent value to shareholders. They have done that. They've done that over and over and over. So that's why I like Apple. But anyways, I appreciate all of you for watching. If you enjoyed, appreciate you like and subscribe. I do daily stock content on this channel. I appreciate all of you for watching, and I'll catch you next time.